Yeah, it's been an interesting time for sure. And I think from our perspective, it's not entirely unexpected. We've seen markets rally pretty aggressively off the bottom in the last 3 or 4 months. And so when we think about the short-term risk, clearly at the front of all investors' minds is the risk of that second wave of coronavirus cases. And we haven't seen that materially emerge in Europe so far. And that's why I think markets have been a little bit more forward-looking, a little bit more long-term in their mindset, saying we are going into a recovery phase. And whilst that will be somewhat more gradual on the tertiary side of things, it should still be positive for earnings growth over the next couple of years. But there is clearly this read across to the US and the fact that we are starting to see these localized shutdowns, the rollback of some of these reopening measures. And so people are a little bit nervous just because of where markets have got to in the last few weeks.
I want to get to technology as a sector to invest in, because a lot of the fund managers think that this is a quality area. It has growth elements, but also defensive because of the subscription revenue. You're also pointing to the technology side of the market, but how concerned do we need to be around this Facebook story? Because clearly a huge component in the FANGs, and we've seen that well-known management team has continued to make some very rough decisions around policy, and that impacted Facebook stock Friday. Do you think there are ramifications for this technology gain that we have witnessed?
Well, I think if we just take a step back and think about technology more broadly and think about how the sector has done so far this year, and clearly it's been very resilient, there's reasons for that. One is clearly these companies have Loctite balance sheets. They've got cash on balance sheet in many cases, and they can self-fund even through a more protracted shutdown. But I think over and above that, what you've seen is an acceleration of a lot of those technical advancement trades that you've seen over the last few years. So things like social media, e-commerce, online internet penetration in general has just been accelerating through the course of this coronavirus crisis. And we don't think that necessarily changes, even if we go back to a little bit more normality. Now, I think there is a risk in technology in particular around regulation, and that's something we've pointed to for a number of years. But if you think about the short and long-term consequences of coronavirus crisis, we'd still say that is net positive for a lot of the big technology platforms. If nothing else, you've seen a consolidation in certain areas where the real dominant platforms have continued to gain market share. And with the backdrop of acceleration, a lot of those macro trends like online penetration, like digitalization, and frankly, just the push for greater use of data, we think that is net positive for the space in general.
With you around the market dominance getting even stronger for some of these technology companies, but we have seen some catch-up take place there. Very traditional industries that saw their revenue just fall off a cliff because of social distancing and lockdowns, then being forced to pivot much more aggressively than they had been doing towards technology. Do you think we see any result? Does that have any impact for the profitability when we finally return to normal?
Well, I think we have to separate exactly what we're referencing there, Karen. I think if you look at the measures we've seen over the last few months and what that means long term, clearly there is a potential impact on cost for businesses that are in the services economy, for businesses that are offering people an experience in real life where they have to aggregate with other people. And so that is a concern if you think about margin for certain areas, but we have to weigh that against the secular growth trend we're seeing in that space where, frankly, we've got a millennial consumer who wants to spend money on experiences. They want to do things in real life, and that's not realistically going to change. And so for us, there is clearly a short-term impact, and that's something we've been flagging to our clients for a number of months. We have to be very cautious around that experiences space, the fact that it will be a more protracted reopening, and that can be quite significantly negative for certain companies in that space. But for those that have the balance sheet strength to work through that period, that actually can be very net positive. Now, I'd say on the retailing side of things, for us, this is just a further reinforcement of the view that unless you have a complementary online, offline retail model, or you have some kind of unique proposition that will bring people into your stores, this is going to be a further headwind to traditional bricks and mortar retail. And so that is something that we're continuing to flag to our clients and just saying, look, you're going to see disruption in this space, probably even more aggressive than we've seen over the last few years. And clearly that backdrop has been quite challenging, even without the context of what's happened in the last few months.